Hey, hello and welcome. My name is Victoria Keane and I'm from Homes England's Local Government Capacity Centre, and I'm delighted to welcome you today to our summer learning programme. This offers a series of knowledge sharing sessions on topics that you've told us are of interest to you. Today's event is called Housing Market Insights with a focus on the South. So before we start, I'm going to take you through this slide here to introduce you to the Local Government Capacity Centre and its function. So this summer learning programme is brought to you by Homes England's Local Government Capacity Centre. And this slide summarises who we are and what we do. And we've launched the centre following extensive research and consultation with you across local government and with a whole range of other partners to determine where authorities most need support and how this can be best delivered. And we look forward to hearing how we did in the survey polls at the end, and also for you to tell us what you'd like at future sessions. Next slide, please. Okay, so here's the agenda. So we're going to start off with Fionnuala Early, who's going to go through an introduction and a macro overview. We'll then hear from Francesco, who's going to take us through the housing market insights details. Then we'll have a forward look from Imran, and then we'll all come together for a Q&A. And it would be great if you post any questions in the chat and we'll pick those up in the Q&A. And then we'll get some final thoughts and feedback from you to tell us what more you'd like to know about this subject, and also what other subjects you'd like the Homes England Local Government Capacity Centre to look at in future learning programmes. Okay, so without further ado, I'm going to pass over to Fionnuala. Thank you.
Well, thank you very much. Sorry you can't see me. Well, I'm Fionnuala Early, and I'm going to talk a little bit about the macroeconomy, the challenges that we're faced with at the moment, and what we've come through. And then my colleague Francesco is going to talk to you about the housing market and take some of the links from what's happening with the macroeconomy and what we see happening in the housing market and the particular challenges that we see there. And then finally, Imran is going to get his crystal ball out and tell us all about what was going to happen in the future. So looking at the forecast and the scenarios that we might face, and what that, again, might mean for us all. So I hope you enjoyed today, and without further ado, we'll press on. So next slide, please. So I'm going to talk a little bit about the wider macroeconomy, what's been happening and what we're faced with now. So out of the frying pan into the fire, we've come from this tremendous pandemic that pushed the economy into the deepest recession since the Second World War. We're out of that just about, and we're now seeing with a perfect storm of inflation, higher interest rates, public sector finance challenges, low consumer and business confidence, and on top of that now a change of Prime Minister on the cards. So what does this all look like? Next slide, please. So as I mentioned, we went through the deepest recession since the Second World War, and that's basically because we couldn't go out and spend. We were all stuck at home with our lockdown restrictions, and it was quite a rapid recovery once those began to be lifted. But it does tell you an awful lot about what drives the economy. If we couldn't go out and spend, and then the economy just doesn't grow. People's demand just evaporates, and that really pushes us down. We've come back up now. We're almost where we are pre-pandemic, but we're not where we would have been. We've lost some of that productive capacity. We're about 5% smaller than we would have been had the pandemic not happened. So we've still got a little bit of catching up to do. Next slide, please. So how did we manage it? How did we manage to get quite quickly out of that? Well, I think we should put it down really to the performance of the labour market. It really was a nice surprise, supported enormously by the furlough scheme, a very, very, very expensive scheme that the Chancellor put in place, but it seemed to have done the trick. And it continues to surprise us, the labour market. We're really surprised at that we've got the most ever payrolled employees, right up at record levels there. Unemployment is falling, and it's around about at pre-pandemic levels now, and vacancies are also at record levels, and it even looks like there's some jobs to spare. We've got more vacancies than we have unemployed people. It's not quite as simple as that, of course, because lots hides behind statistics. We know that there are fewer self-employed people, so they've moved into the labour force, so that's why we've got more. We've moved into the paid labour force, so that's why we've got more payrolled employees. We also know that the workforce is a bit smaller, which flatters the unemployment rate. That's partly because some people have left workforce. They've decided, particularly those people in their 50s, they seem to have just thought, well, I'm not going to bother anymore, I'm going to retire and enjoy myself. And then we've had about 500,000 migrants leave the UK, and that's reduced the size of the workforce too. But overall, the labour market has done very, very well. But there are some regional differences, which you'll be familiar with. Next slide, please. So the national picture disguises what's really happening. So we've got levels of unemployment down at about 3% in the East Midlands, funnily enough, and it's closer to just over 5% up in the northeast. And that's a typical pattern of unemployment, which reflects really where the economic activity takes place and where there's greater need for employment. But also, the labour market is made up of people who are inactive as well. As I mentioned, that affects our employment levels because they're not counted in the workforce, and it affects the productive capacity of the overall economy. So if you're not working, then you're not producing things, and the economy doesn't grow as fast as it might have done otherwise. So you can see here again, it's a similar pattern, more inactivity in the north than in the south. But one of the things that's been inactivity has been increasing over time since the beginning of the pandemic. But one of the drivers of that inactivity, which has been picking up since the start of 2021, is long-term sickness. And that's maybe one of the legacies of COVID that we might have to deal with going forward. So that's something for employers to think about as well. So the labour market has been a nice surprise, but I have to say that's probably the good news over. So we can have the next slide, please. So out of the frying pan and into the inflationary fire. So inflation is now running at 9.1% at the last count for CPI, the target measure for the Bank of England, and the target is 2%. So we're really way off the scale in terms of reaching the target. That's the highest it's been in 30 years, and it's going to continue to rise. It's clearly making things difficult for all of us. We notice the increase in prices ourselves. Just our fuel bills and everything, but for poorer people in the economy, that's even worse. If we look at the chart on the right hand side there with contributions to inflation, the things that are rising most quickly are housing and household services, which will include gas and electricity prices, transport, obviously petrol prices, and petrol is the highest at the pumps that it's ever been, and now we're seeing food prices beginning to increase. Now why that makes poor people, hits poor people more than everybody else, is because they spend a disproportionate amount of their income on these things. They're essentials that they can't avoid spending on. People who are a bit wealthier, they can choose then to cut back on having their nails done and stuff, and they can still afford to buy as much food as they need. But this does, for people who don't have that luxury, it hits them much, much harder. So that's more bad news, I'm afraid. But what does this mean for us in terms of cost of living crisis? So next slide, please. So inflation and prices rising wouldn't really be a problem for individuals. They'd still be able to afford to buy what they needed if their wages increased in line with it. Now, that's not happening at the moment. Inflation is far outpacing wages. They're just not keeping up. So what that means that in real terms, that's economist term for adjusting things for inflation, put it in real terms, then actually wages are falling. We can't afford to buy as much as we would have done. Our purchasing power is lower than it used to be. But again, that has industrial and regional differences that don't show up in the main data here. So for example, in the financial services sector, they're seeing bonuses of around 10%. And those people who are lucky enough to get such nice hefty bonuses tend to be placed in the southeast, where the big investment banks are, who are the ones that get most of the bonuses. So that makes a bit of a difference. And there's also a public sector, private sector difference in terms of wage growth. So the public sector, a lot of us on this call and us sitting here giving it are suffering from public sector wage fees and wage freezes, and public sector pay is only running at about 1.8% or 1.5% because we don't get bonuses, whereas it's running about 8 or 4.8% in the private sector. Now that's really shows you that there are differences amongst this. So looking at the national top level data tells us one thing, but there are other nuances underneath, and that makes a difference for people working in different localities. They're faced with different challenges, and that's true for recruitment, and that's true for how much you have to pay people, and that will put pressure on budgets as well. But we have troubles with our finances, but so does the government. So the government has spent an awful lot of money throughout the COVID. The furlough I mentioned was a very big, very expensive scheme, and so are the business support schemes. And so we can see here, this is government debt, and it's as a proportion of GDP. So it sort of normalises that. So you can see it's a bigger burden. It's a bigger burden for the government than it used to be. And that's even more difficult for the government at the moment because interest rates are rising. So not only do they have a higher level of debt that they need to get rid of, but the interest on that debt is also rising when interest rates rise. And they've got other challenges too. So we've got defence spending. The difficulties in Ukraine. Is defence spending, has it been cut back too far over the past? Challenges there. Climate change, that's going to involve more government spending, another challenge there. Welfare spending, the NHS and commitments there, that's not going away. And now we have questions in the leadership election, for example, about tax cuts. Are there going to be tax cuts? And if those tax cuts come through, how are you going to replace that revenue? Or is that going to mean that government debt is going to increase? Or will it mean that we'll have a cutback in public services and a further freeze on public sector pay? All of those things are challenges for the government, which will also affect, as I say, local authority budgets, planning budgets, housing budgets, all of those things. So next slide, please. So inflation is bad. It's not good for us. It's causing us challenges with cost of living. But why is it so bad? And why is it so bad for the economy? Well, when inflation is going up, as I mentioned earlier, we can't spend so much on other things. And because consumer spending is really important to our economy, about 60% of our economy is driven by consumer spending. The less that we have to spend on things, the less the economy can grow. And if we're not spending on things, that reduces demand, that reduces GDP, and what you end up in a situation where businesses start to go bust and unemployment begins to increase, and that you push yourself into a recession and a very bad state of affairs. So what we're seeing here at the moment is consumer confidence is falling really rapidly. That suggests that they're not going to spend very much. Retail sales data out this morning showing that retail sales are significantly down. People really beginning to feel the pinch now. But also on the business side of things, business investment is really important. Businesses drive the economy. They can increase efficiencies, they increase our productive capacity and improve our competitiveness so we can sell more abroad. But inflation is really bad for businesses because it creates uncertainty. And that uncertainty is about what demand they might have for their products. So is it the right time to invest now? It's also increases uncertainty about the prices that they might charge. So if they get the price wrong in an inflationary period, they've either got to keep changing those, which gives them additional costs, or they lose money, or they price their customers out. But the other thing that businesses face, which is a disincentive to invest in an inflationary period, are higher costs of funding. As interest rates increase, so does the cost of funding, and so it makes perhaps some investments less viable than they might otherwise have been. So all of these things are bad for growth, and they're bad for our economic growth and how quickly we might recover and how quickly we might feel better. Next slide, please. So on the individual side of things, closer to home, inflation is also bad because it really hates savers and it loves borrowers. It makes it much harder for people to save money for deposits and to get into the housing market, for example. The chart on the left-hand side shows you if you've got £1,000 to invest, if your interest rate was at 2%, at the end of 10 years, you'd have just over £1,200. But if you take into account inflation, it actually reduces the initial sum down to around about £750, just less than that. So you can see that it really erodes the value of your savings. That makes it much more difficult for people to enter the market and to save up their deposits, and is also for pensioners and people on fixed incomes. For people who are already in the market, it's great because their debt, the value of their debt, is eroded in real terms as well. Their wages increase, but the burden of their debt reduces, and you can see that on the right hand side. So they at wages increasing at just 2%, the burden of the debt reduces from about 25% of income down to about 15%. But if their wages are 7.5%, then it's down to about 5%, making them much richer. And the issue there is about further inequality, and the accessibility of housing, and inequality between homeowners and not homeowners. And for renters too, their rents tend to rise with inflation, but that's not the case with mortgages. Rents rise with inflation, they can't save, and then they're no better off. So inflation is bad because it limits economic growth. It causes a cost of living crisis, which hurts us all. It hinders investment, it hurts savers, and it makes it more difficult for people to enter the housing market. So what can we do about it? Next slide, please. Well, interest rates are the only tool that we have really, apart from the government just cutting things back so everything tightens up. But it's the only sort of tool that we have that we can move quite quickly. But it's a bit of a blunt tool given the drivers of inflation at the moment. The things that are driving inflation are global commodity prices. You look at the price of oil there, how quickly that's gone up between January 19 and now. And we get a double whammy there because sterling's not doing well against the dollar, and because oil is priced in dollars, we get a double whammy. It becomes even more expensive for us. So commodity prices, there's trade frictions across the world. It's not just to do with Brexit, but the trade frictions across the world which are causing prices to increase. There's COVID that's causing supply issues and also increasing prices. And then there's the war that's leading to sanctions and shortages of commodities again, and that's causing an increase in prices. But all of these things are coming from outside, so it's not driven by domestic demand, which is what interest rates would be able to deal with very quickly. So you might ask, why is the Bank of England increasing rates? May I have the next slide, please? So the bank is increasing rates now because it's its only tool at the moment, and it needs to send a really strong signal that it's going to prevent inflation becoming embedded. So it's raising rates now, even though they're not going to affect the causes of inflation now, but they will affect the causes of inflation that may become embedded, that would affect inflation in 2 years' time. So those price expectations, if we think interest rates are going to increase, then maybe we won't spend quite so much now. That will cool demand as we start to get better. And also in terms of wage demands, any increase in wages, if you know interest rates are going to go up, that'll negate that and then reduce domestic demand. So if you have increases in wages now, then that would allow people to spend a bit more money, and that would stimulate the domestic economy, and that's not really what we want at the moment. We need to, if we want to bring inflation down, so the Bank of England has to keep on top of that. That's why it's so scared about a wage price spiral. If wages start to increase, then that increases domestic demand, which increases inflation, which increases wages, and it makes it much more difficult to get inflation down in the end. But it's a very, very difficult line for them to walk. It's a very difficult time at the moment, and particularly with political uncertainty as well. If they raise interest rates too quickly now, they could squash any recovery and growth by increasing the cost of finance, by making people feel less comfortable about where they are, and decisions to invest and to spend. But if they don't raise interest rates quickly enough, then we risk that inflation becoming embedded and having to take a much, much harsher view, and maybe pushing us into a recession before then. So this chart on the right-hand side, this is showing you what markets expect to happen to rates. These are the financial markets. And so this perhaps shows the contrast really between what the Bank of England has to consider. The markets are just considering, oh, look, this is what interest rates look like they're going to do. So they're expecting them to rise to around about 3%. But taking into account the other things that the Bank of England has to consider, then it doesn't think that this is a forecast from Oxford Economics, forecasting house that we use. The expectation is that interest rates will settle at around 1.75%. Now that will be taken into account expectations about what's going to happen on the public finances if we're fiscally tighter, if the Chancellor doesn't give us loads of tax cuts and it cuts back on public services, that takes heat out of the economy and means interest rates don't have to rise as much. And if the Bank of England anticipates that people their inflationary expectations are not as high, then that gives them a little bit more room as well. So that's all I've got to say today. I think we should say that the labour market's been our saviour, but inflation is really a risk for us, and we've got a bumpy time ahead of us. So I'll pass over to Fran now, who's going to tell you all about the housing market. Thank you very much.
Let's jump on the housing market. So you've seen the macro outlook, which is, let's say, mixed. So there are positive news in terms of how quickly the economy has recovered from the pandemic, even though there is still a gap. But the housing market is, the labor market is particularly strong. But when we go into the housing market, we can see that there appears to be headwinds ahead. And if we go to the next slide, we'll see where we've been so far. So there's our two charts that show house prices in the UK. The one on the left shows general house prices, and there are different indices showing it, and I will go through what they mean. And on the right-hand side, it just shows different types of products. So detached houses, semi-detached, and flats. And there is a lot to unpack in this slide, so bear with me. First, on the house prices chart, you can see that we look at different indices at Homes England. This is because different indices measure different things. The Rightmove data show the asking prices on the Rightmove platform. Nationwide data uses the data that Nationwide uses based on mortgages. So, for example, it excludes cash buyers. And the ONS are the ultimate data. What it's interesting to see is, despite the variability, there is quite a consensus on the general trend. And you can see in the last 2 years, the increase in the annual change, so like how fast their prices have increased, has been quite consistent. Prices have gone quite fast. Now you can see first from Rightmove and from Nationwide, maybe this trend is starting to reverse already. And we'll go in the next section with my colleague Imran. We'll see what we think about the future, where this trend has actually started to moderate. But the interesting thing about house prices is that not all house prices are the same. And as you can see by the distinction by product, you can see that detached housing and semi-detached have gone very fast, whereas flats have increased less so. And there's a number of reasons for this. One is the much touted race for space at the beginning of the pandemic, but that is only a part of the story. And you can see that the underperformance of flats far predates it. You can see that it starts probably for mid-2017, so definitely linked to Grenfell. But in general, from the pandemic, one of the reasons for the lag is that the households that were still able to transact and buy houses and go look for houses were not the average household, were the household that were particularly better off, that were feeling less so the struggles of the pandemic. They had actually managed to save, and those households are the households that tend to buy detached and semi-detached. They're not the first-time buyers necessarily. Those are the second and third steppers, and so they are less likely to buy flats, and that's what explains that difference. So it's very important. And when we say that all house prices have increased, not all products have increased at the same pace. If we go to the next slide, thank you. It's not just that not all products have increased at the same pace. It's also that prices have increased at different paces in different regions. However, from this chart, you would think, oh, prices have broadly increased above 10%, broadly everywhere across England. However, one thing to remember is that when we say prices are up 10% in a specific region, we have to remember the base, the comparison base. So what is the average house price that now in that region? And you can see that in the North and the Midlands, the average house prices are markedly lower than in the South and the East. And so even in London, where house prices have only increased 8% in the last year, that still in absolute terms is a much greater number than in other regions. So while in percentage terms there is a catching up to do, London and the South are increasingly prices are increasingly out of getting unaffordable. And you can see this very clearly if we change slide in the next chart, because we've mapped affordability across England. You can see this in 2003, 2011, and 2021. the affordability ratio is the ratio between the local house or the median house prices in a local authority and the resident incomes, meaning that if the house prices is a certain multiple of the resident income, it becomes less and less affordable. And there are other factors that impact affordability, but focusing just on this, you can see that in the south and in the east, house prices have become increasingly unaffordable. Broadly everywhere now, house prices are now over 9 times the median resident income. And this has been driven in part by relatively cheap mortgage rates up until a few months ago that have pushed house prices up, but also a lack of supply in the southern regions. And if you go to the next slide, we'll see how this potentially is going to change, because the cheap interest rates that have supercharged house prices in the region in the last up to 10 years really are starting to change. The tide is starting to change when, as Fionnuala mentioned, when the Bank of England has started raising interest rates in December, mortgage rates has started increasing almost straight away. The pass-through has been very quick, and now you can see that the fixed-term mortgage rates, so the mortgage rates that people would pay on a 2-year fixed-term mortgage, have increased quite significantly across all loan-to-values. And loan-to-values is a shorthand to say the size of your deposit. So a 95% loan-to-value, it means you have a 5% deposit. 90% loan-to-value, it means you have a 10% deposit, and so on. And you can see how across, it doesn't matter how large your deposit is, your mortgage rate, if you were to ask for a quote for a mortgage right now, will be significantly higher than it was even just 6 months ago, or 6 or 8 months ago. And that has clear implication about the size and affordability of one's mortgage. And you can see that in the next slide, which is a bit complex, and I'll spend a bit of time talking about this, so bear with me. So what affects the affordability of someone's mortgage is, on the one hand, how high their interest rate is on that mortgage. So that is the y-axis, the vertical axis. And on the other end, how large the amount that they have borrowed is, so their loan-to-income ratio compared to their income. You can see that over time, this ratio has changed. The relationship between interest rates and the amount of money that people have borrowed compared to their income have changed quite a lot. However, when you consider compared to what proportion of income this amounts to in terms of what then happens in terms of the monthly mortgage that people pay, it has now been relatively low for over a decade. So on average, people with a mortgage will pay just over 15% of their income in their mortgage. And that's because, despite the fact that the average loan-to-income ratio has increased over time in the last decade, the interest rates have gone down. As we touched upon, interest rates are not going up. Prices are not necessarily going down as quickly as interest rates are going up. And so you will see the red line in this chart starting to go up vertically and moving towards the 20% of income. We're not particularly worried about this for a number of reasons. One is 20% of income is still relatively affordable by and large. People that have received a mortgage, the people that have a mortgage have been stress tested with the affordability test by the Bank of England. So even if their mortgages increase by 3 percentage points, or 300 basis points, they should be able to afford repayment, although this did not account for an increase in energy prices at the same time. But most importantly, this is because, and if we go to the next slide, the increase in the mortgage rate will not affect everyone at the same time. The largest majority of mortgage rates in the UK is a fixed term, meaning that when interest rates on mortgages changes, it doesn't necessarily change for everyone. Most people have a fixed term of at least 2 years, but up to 5 years, and a very small percentage over 5 years as well. You can see in this chart, is the black area that is the people on a variable rate. And in the last few years, the people on a variable rate really have gone down. There was still around 10% in 2016, but really now I think it's only about 2 or 3%. And the greatest majority of people lock in their mortgage rate for security. And this just means that even though the Bank of England is raising rates and the quoted mortgage rates are increasing, people that already have a mortgage are sheltered from these changes for a while. Clearly, this does do nothing to help people that want to get on the ladder, because now it's more difficult to save. House prices are still high and mortgages are more expensive. But what this prevents, well, this protects existing homeowners. And once again, we could see earlier what Fionnuala touched on it. Existing homeowners are sheltered and are helped by inflation, and prospective homeowners are not. So again, this is another aspect. So existing homeowners will be okay for a while, as the higher rates take a while to pass through. But the prospective homeowners really are the ones who struggle. And as we move to the next slide, we move to really the segment that we're a bit more worried about. Oh, actually, the first thing to point out is that in general environment, what we see is that the transaction for houses seem to have gone back to normal. There are two ways to look at this. This is Bank of England data that just shows how many mortgages are approved for house purchases or for remortgaging. And you can see this in two ways. One is, finally, after the shock of the pandemic, that really saw this chart in dark green peak and then remain elevated for over a year. Now this has gone back to pre-pandemic level. So this is when you look at the absolute values. However, you can also look at this looking at the direction of change, and you can see that the number of approvals for house purchases has been falling and falling and falling, and the direction is really just one that is decreasing. So my colleague Imran will go through our forward look on what we think will happen to the housing market, but this is just to show there are different ways to look at something that seems to be just going back to normal, because the situation right now, even though the absolute value is the same, is much different from the pre-pandemic level. Moving on to what we think is probably one of the most exposed segments of the market, we like to focus on private rents, because while we were saying that existing homeowners are relatively sheltered by this, private renters are not. You can see this is ONS data on private rentals, and this tracks all renters, so existing tenancies as well. This is not strictly just the advertised asking rents that you will see on platforms. And you can see that even when you consider all the rents, so people that renew maybe at the same price, rents on average are going up in England, excluding London, by nearly 4% this year, or at least in the most recent 12 months. And this compares to real wages, so wages after taking account of inflation, that is the gray area, actually decreasing by over 4%. So there is a real squeeze for renters that, with their housing costs going up and energy costs as a side, they're not shown in the chart, but you know what's happening, what happened in April and what's going to happen again. And they are the ones that are not sheltered by their mortgage, the size of their mortgage, their increase will happen to them straight away. So we're relatively worried about private renters at this stage. And if we move to the next chart, we can also see the impact from the beginning of the pandemic, because after a lull in which it looked like no one wanted to rent a house and rents went relatively lower, actually the change has been quite striking. This is a Zoopla chart that shows their asking rents by region, and you can see that in every region since March 2020, asking rents have increased by quite a significant amount. In the Southwest is the largest amount in absolute terms. Rents are now nearly £130 higher than they were pre-pandemic. And if you focus on the pink dots in the chart, that shows what proportion of the income of local people that is, what additional proportion. And you can see that it's in some cases, for example, in the Southwest, it's nearly 5%. So like an increase in 5% in housing cost on top of not a strong labor market as we would expect for people that are renters and were not able to work from home, most likely. This is people that don't necessarily have the same security as homeowners and are now between really a rock and a hard place. And if we go to the next slide, we can also see that when we talk about rents, we actually really should stress that the affordability levels are quite different. We've seen the maps earlier that show affordability levels for home purchase, but there is quite a lot of variations for rents as well, both across regions, which, as you can see, is the average affordability in the dots, in the dark purple dots, and also within regions. So the height of each of these boxes is the difference between the minimum and the maximum affordability in every region. And you can see there is quite a lot of variability, and excluding London, there's quite a very large box on the right, but you can see that even across the southwest, there are places where it's least affordable that is like very much comparable, increasingly, it's much higher than the southeast, which is usually taken as an example of the least affordable area in terms of rents, other than London. So you can see that there is quite a lot going on in rents, and the reason that drives this is simply there just isn't enough supply. The demand is there, the supply isn't, and because of this imbalance, it just means that prices are going up. This also has spurred quite a lot of investment in the sector. If you're interested in this, there are other sections that we've held with the local government Center of Excellence on build to rent, and you can go and catch up on them. I believe the videos will be available shortly, but for now, you're stuck with me, and you're going to have to believe me that rents are getting increasingly unaffordable, at least as a share of joint income of basically in every region. If you can go to the next slide, I believe we're just touching on, in general, how has the market reacted to this? There are 3 lines on this chart, and this is one of our top tips when you don't know how the housing market is going. Looking at housing statistics can be a bit tricky because they are a bit lagged. They're not as timely as we'd like them to be. So what we look at Homes England is the energy performance certificates. So EPCs, most of you will have them in your house. That's how efficient your house is at retaining heat. And they are quite timely. So, and when we look at the ones that are issued for new build dwellings, they are a very good proxy for how many completions there are. And you can see that in 2022, we're broadly tracking 2021. So the new build market is doing quite well. It's still, despite the headwinds that we expect to see, is still doing quite well. You can see how the huge drop that had happened in 2020. So what we can say is, so far, the new build market has held on. However, you also have to see this in line with the new build market has been building at the same pace as last year's, despite the fact that house prices have been going up 10%. So there is maybe a cap to how much they can provide to the market. If we go to the next slide, we can see one of the main challenges that the new build market will face, which is the increase in material and labor cost. So this is something that will affect registered providers and developers in the same way. And it just shows that material cost, if you see, this is a very boring, until 2021, this was a very boring chart. Prices were not changing that much. There could be forward contracts for months ahead that could be still valid. Right now, changes are so rapid. It just means that it's very difficult to get hold of materials at a cheap or affordable price. And you can really see this in this chart. But the materials cost has increased so much and is now expected not to increase as fast, at least by the BCIS. But labor costs are expected to increase a bit. So far, this has not been dramatic necessarily because of house prices. So because house prices have increased in line with the increase of input cost, this has meant that viability has remained, at least for the larger players. However, very many SMEs have struggled because they necessarily don't have the same purchasing power than larger organizations. So this is another one after the alongside the private renters. Another one of the segments that we are a bit concerned about and we're tracking at Homes England would be SMEs, because SMEs are once again between a rock and a hard place when it comes to increasing costs, because really they are price takers. They can't necessarily buy in advance. They can't manage their supply chain as well as the larger players. If you go to the next slide. Thank you. Last couple of things about looking ahead to an extent and see the challenges that SMEs will have, but like developers in general. One is neutral neutrality. There was a session on neutral neutrality offered by Homes England and the local government Center of Excellence. Do catch up on it. The video will be available soon. But this is just to show there are areas of the country where development is going to be particularly difficult at the moment because of limitation by natural England and neutral neutrality. You will definitely be aware of it. It's very localized areas, but the areas where the issue exists, the largest majority of land at the moment would struggle to get planning permission. This is an issue that you are aware of. I'm not going to touch on it regardless, but I think what we found interesting is when we overlay this this nutrient neutrality issue on top of existing development constraints. So when we consider areas that are already covered by greenbelt and flood risks and rural heritage side, we can see that there are local authorities where over 75% of the land is now not available for development. And in a concept, in the environment in which we say the issue that is driving house prices up is that the supply is not meeting demand. The idea that there is 75% of land that is, in practice, not available for development creates many issues in terms of closing that gap between supply and demand. So this is something to keep in mind. There is an entire session about this if you're interested, and do catch up on it. And finally, for me, for the housing market, a word of caution. So if you can go to the next slide, you will have seen that the census 2021 has been published, and this is great. This is great news. We were well overdue some new data, and we didn't want to use 2011 data anymore. And there are some things that is worth pointing out. The ONS will be publishing very detailed data in the future, but be cautious of getting to just early conclusions with it, because you may remember that this was held during one of the lockdowns during the pandemic in March 2021. And that just means that the results, while they're good, and the ONS will make sure that they are very reliable, may have some issues. So, for example, we have the number of dwellings and empty dwellings being higher than the number of households. The number of dwellings being higher than the number of households. And some people would claim that just means that there isn't a supply issue because there are more houses than households. However, that is debatable. The household size has increased for the first time in, I believe, 70 years, and that's because there are a lot of quote unquote suppressed households. So the households that during that lockdown weren't necessarily living by themselves, and we're thinking maybe young graduates that hadn't decided to move out to the city yet. And so we're still living with their parents. That is a so-called suppressed households, or simply people that could not afford to move out during a pandemic. So just keep in mind when you use Census 21 that there is the timing when it was run will have an impact on the validity of the data, and you can expect this to impact housing projections and population projections in the future. And so this is going to be very relevant. Lastly, we just want to ask a few questions about what you think is going to happen. So now that you've had a macro overview and a housing overview, what do you think is going to happen in the economy and in the housing market? So we do this internally. We've read a book, Super Forecasting, a while ago in England, and it got a bit over our heads. And we started asking these questions to colleagues, and we found out that our colleagues are very good at forecasting the near-term future. So what's going to happen to the housing market and the economy in the next 3 months. And we basically would like to ask you the same question. So if we can go to the next slide, there should be the first prompt. Yeah. And if we can launch the survey. So what do you think is going to happen to house prices in your region in the next 3 months? And if you can answer the question. So we've touched upon the supply demand imbalance remains. And I can see the majority of people still think that there's going to be a small increase in house prices, despite the fact that mortgage rates are going up. And so they're making it less affordable to buy houses. But we still think that the housing market, I see, the net score, which is what we use, so the difference between the positive responses and the negative responses, still seems to be very positive. Very few people think there's going to be a big drop or a crash. And people are still quite confident. It's great. And if we can move to the next slide. So this next slide, sorry, the next slide again, and the next poll question is about the economy. So how do you feel about the economy instead? So not just the housing market, but the economy in the next three months. It's much less optimism about this. It's very interesting, which makes sense. This is what the expectations are. I can see we're getting lots of responses still, but yeah, I would say that the net balance of this is quite negative from our audience today. Not sure if this is a testament to us doing a bit of scaremongering, but it feels like given the challenges and the headwinds ahead, the what the audience today feels is that the house prices in the next few months will still maybe have something to gain, but the local economies will struggle a bit. And if you just very quickly compare it with what our colleagues at Homes England have been doing the last few months, so the next slide should have the results of what we do over time. So in green, you can see the Homes England responses, and in light green or yellowish, you could see what the actual data were. And you can see that our colleagues are very good at just looking at the direction of change. And you have to keep in mind, our colleagues say, like, get that same shape of line 3 months ahead of the actual data. And the actual outbound data get published even later. So we managed to have quite a lot of quite timely data, like very good nowcasting from our colleagues. You can see that our colleagues on the left-hand side think that house prices are still going to increase, much like our audience today, but less so, and increasingly less so in the last few months. So still in a positive territory, but decreasing over time. On the other end, our colleagues have been relatively negative about the economy since early 2020. That kind of coincided with the war in Ukraine. And you can see that on the economy line of what has actually happened, that have kind of turned true, although the changes in the actual size of the economy are just much less dramatic than what our sentiment is. And I would say that our audience today feels like a bit like our colleagues, so relatively still positive for house prices and a bit much more negative for the economy. So thank you for playing this game for us today. It was, it's very good. I'll pass on to my colleague Imran and his crystal ball, and he's going to tell us about what we think is going to happen going forward. Thank you.
Thanks, Fran. Morning, everyone. So I've got my crystal ball out. I'm not sure how crystallized it is, but I will do my best. So we've seen what our partners are thinking about the about the short-term outlook, as well as kind of what the audience here thinks too. So I'm now going to talk through some of this in a bit more detail and outline our view of the future and kind of our approach as a team to economic forecasting. So, despite my crystal ball, we are not psychics. We are a delivery agency. So in forecasting, we focused on understanding what different scenarios and risks means to us as a delivery agency. So that's, what does this mean? What does it mean for our programs, our projects, and and our aims and objectives as an agency? So what this means is that it's not all about what the numbers are for each indicator. It's much more about, what the story is for the different scenarios and, what does it mean for the different themes. So kind of it's this first part, the story and the narrative that I'm kind of going to focus on over the next few slides based on forecasts that we get, that we subscribe to from Oxford Economics, an internationally recognized consultancy and forecasting house. So if we move on to the next slide, please. We have the headlines for our for the central kind of base case forecast. So firstly, it's a gloomy economic outlook. Unfortunately, this section is going to be a little bit gloomy, and I can only apologise, but please don't shoot the messenger. So as Fionnuala described at the outset, the global economic outlook has deteriorated, and it's very uncertain. So certainly in the short term, growth will be sluggish. At the heart of this is high levels of inflation, with a forecasted peak of over 10% by the end of the year, but it will fall away sharply within the next 2 years. The other key headline is the hit to the cost of living, and we've heard in the media about the cost of living crisis, and unfortunately, it's not going to get easier in the short term. On the other hand, the labour market has been relatively strong, and that is forecast to continue. And in terms of the housing market, we're expecting it to cool significantly as demand falls, with a fall in prices in 2024 and a subsequent slowdown in supply too. We characterize it as a correction in the market rather than a crash. And with an uncertain outlook, there are many risks on the horizon. To us, a prolonged and more severe conflict in Ukraine is the key risk, and I'll talk through later our approach to dealing with this using economic scenarios. If we move on to the next slide, please. So firstly, what the first headline is it's a gloomy economic outlook. Growth is sluggish. And we can see this here on, on the left-hand side, where we expect kind of annual GDP growth to average less than 2% until 2027. Growth will be lower than what we previously expected, and that's because of the deteriorated economic outlook. So, back in April, we had a forecast of growth of 2% by 2023, and now we're forecasting growth of just 1.3% by 2023. So growth is going to be lower than what we previously expected. It's going to be low by historic standards. So it averaged 2% between 2015 and 2020, and it's going to be less than 2% for the forecast period. And then growth will also be low by international standards as well. So here on the right hand side, we have average annual growth rates for other countries for the next 2 years, and we can see kind of where the UK ranks behind other kind of major countries, as well as the Eurozone and world averages as well. So if we move on to the next slide, the headlines have been about inflation, and rightly so. And there's a mix of good and bad news regarding inflation. So the bad is that they will continue to rise, and we can see here on the left-hand side, inflation is forecast to peak over 10% before the end of the year. Why is that? Well, we have the kind of a further rise in the kind of regulatory price cap, plus continued increases in fuel and food prices in particular from continued supply chain challenges. And the other point is that inflation expectations are a big driver of actual inflation, and this kind of growing evidence that the public is starting to expect consistently high inflations, and that's starting to embed itself into the forecast. So that's kind of some bad news. The good news is that it will fall away relatively quickly as kind of the fuel shock this year falls out of the calculation for inflation. Unfortunately, the bad news again is that despite this, the UK will continue to have one of the highest levels of inflation amongst major economies, and we can see this here on the right hand side. Double-digit UK inflation by the end of the year, in contrast to inflation in both the US and Eurozone, where it should have already begun to fall and fall away from a lower peak. Why is that? Well, there are a couple of reasons. One is the UK's dependency on external energy supplies, particularly on gas imports. The other point is that the energy price cap has created a longer kind of lag between higher gas prices and the pass through of that to consumer prices. And then also we have a tight labour market, and greater wage pressures could play a role in kind of sustaining price growth versus Europe. So that's kind of a couple of reasons of why we expect inflation in the UK to be higher than kind of other countries. If we move on to the next slide, looking at interest rates, the story here is really about kind of the dilemma for the Bank of England, and kind of what Fionnuala kind of outlined earlier, which was the need to contain inflation without crushing economic recovery. So it's all about finding the right balance. The other difficulty here is that the nature of inflation we're facing means kind of increasing interest rates are kind of, to an extent, somewhat a blunt tool to combat inflation. So if inflation is mainly driven here by a supply side shock, so all about kind of the impact on energy supply and energy prices. Interest rates are predominantly a demand side kind of lever, so it will have some effect, but kind of limited, which is why the forecast here is for kind of a relatively low peak of 2% before settling at 1.75% as inflation falls throughout the rest of the forecast period. If we move on to the next slide, well, one of the key headlines of the forecast is about kind of the biggest income squeeze to incomes in 80 years. So where the forecast here is for around a 4% fall in real income by the end of 2023, and then real income growth of just 1.4% per annum until 2027. So real growth here refers to after adjusting for inflation. And we can see here the chart on the right hand side kind of how this is broken down. We can see the main drivers being price inflation, which we've touched on a fair bit, and then also kind of recent changes regarding national insurance contributions and taxes. Although that could all change depending upon the political landscape over the next few months. One point to note is that this is a cost of living crisis, but it's not just all about inflation. wage growth is a key component, and you can see kind of the purple bars on the chart on the right hand side, how that is forecast to kind of shrink over time in the forecast. Now, this is not just a recent, phenomenon. Wage growth has been sluggish since 2007, and it's, arguably at the heart of one of the productivity challenges in the UK. And if you're interested, the Resolution Foundation and the Institute of Fiscal Studies in particular have done lots of great work over the past few months, looking at kind of how much lower wages are now compared to if they'd kind of increased on kind of previous kind of historic trends, kind of pre-2007. So yeah, that's a little bit of explanation as kind of the reasons as to what's behind this kind of this kind of massive income squeeze. It's a mix of recent inflationary pressures, but also long-standing sluggish wage growth. If we move on to the next slide, sticking kind of with the labour market, the key challenges in the labour market are around kind of what I've already mentioned around wages and around incomes. But in terms of the employment rate, it is fairly unremarkable in the sense that the forecast is to remain stable at close to 3.8% throughout the forecast period here until 2027. I think the key story here is not necessarily about kind of the rate of unemployment. It's about two things. It's about participation in the labour market, and we've seen lots of publications around kind of the Great Resignation. So it's about labour participation, and then it's also about kind of the changing nature of how we work, of where we work, of how long we work for, and our working patterns. The future of work, which we don't have forecasts for because it's hard to forecast about how we're working, but there's lots of research and publications on this too that we've seen kind of during the pandemic. But in terms of the headlines for the labour market, it's forecast to remain fairly stable. If we move on to the next slide, please, we're now looking at the housing market, and the key headline is that we're expecting the market to cool down. So what does that mean? So here we've got two charts to kind of illustrate a forecast of falling demand. So looking at prices on the left-hand side, we're forecasting, still some strong price growth this year of 9.8%, but then just growth of 0.5% in 2023, and then a 2% fall in house prices in 2024, and then kind of from 2024 to 2027, an average growth rate of around 3%. And then on the right hand side, we've got transactions falling by 70% by the end of the year, and then kind of growing steadily and kind of the chart leveling off to around 1.4 million transactions per annum. So what's the reason for this cooling down? So there are three things. One is the squeezed household incomes that I've touched on, that will contribute towards cooling demand. The second point is higher interest rates that will help to curtail demand. And the final point is transactions that have been brought forward. So, we've seen a higher number of transactions in the last 2 years that would have occurred kind of in the coming years. They've been brought forward, which has contributed towards a forecast in the, kind of a demand cooling. We'd say we characterize this as a slight correction, but not a housing crash. Despite rising interest rates, distressed sales and defaults are forecast to not kind of drag on the market, and that's due to the robust labour market that I've talked about, and also kind of owner occupiers being in kind of more comfortable positions financially than other groups, and then also kind of the majority of mortgages on fixed rates, cushioning borrowers from rate rises in the short term. So on the next slide, we've just touching a little bit here on rent. So similar to house prices, we're expecting a cool down, but at a lesser rate compared to house prices. And we can see here the forecast is for slightly stronger rental price growth. Why? Well, continued demand for rental properties, particularly in the big urban centres, and a lack of stock will continue to support rental price growth. But that growth will eventually slow due to the relationship of rent prices to house prices, as well as earnings growth, which, as I've mentioned, will both be sluggish. So that's just a little bit kind of on what we're forecasting for rents. If we move on to the other side of the market, so here we've got a cooling market is supply. So here we have a forecast for new housing starts, and you can see in the chart we're expecting the number of housing starts, to level off, mainly due to supply issues and risk, but then also the expectations of lower demand and higher interest rates. So that will feed into the supply issues. The resilience for the labour market is going to be supportive, but builders will be hampered by supply pressures and the squeeze on household incomes in the short term. So we move on to the next slide, please. Just got a couple of final slides just to touch on risk. So that was the story of kind of the central economic outlook. But as always with forecasts, and even more so now with kind of the uncertain economic environment, there are a load of macroeconomic risks and a high degree of uncertainty. So the chart on the left, that shows the results of a survey done by Oxford Economics of kind of their users and clients kind of across the world. It shows what they consider to be the kind of the key short and medium term risks. And we can see the highest is around kind of a more severe and protracted war in Ukraine, followed by a series of risks around inflation and monetary policy. So they're kind of some of the risks globally. And then on the right, these risks have been translated into a series of economic scenarios. And this is our kind of approach in the agency to managing risks. It's in addition to our kind of central kind of economic forecasts, it's to select two other scenarios. That's generally an optimistic upside scenario and a more pessimistic downside scenario. We then model these and use them to test our programs, our kind of project delivery forecasts, and our portfolio to see the outcome under these different scenarios. So at the moment, we consider the most appropriate downside scenario to account for economic risks is the severe war scenario. So on the next slide, we have a snapshot of the downside scenario compared to the central forecast, which I've just talked through. So under this scenario, just kind of very briefly, the conflict in Ukraine lasts well into 2023, with further sanctions imposed on Russia. That leads to further energy price rises and food shortages. So we can see, the predominant impact here on the top right-hand side chart is higher and more sustained levels of inflation, peaking at around 14% rather than 10% in our base case, and inflation lasting well into 2024. Looking at economic growth in the top left, we have similar levels of growth in 2020 in 2022 as the central scenario, but the longer conflict causes the UK to fall into a recession in 2023, and then GDP kind of growth lags behind the central scenario with scarring of around 3 to 4%. Unemployment is also forecast to rise to over 5% as the recession hits the labour market. We can see that here on the bottom left chart. This higher unemployment, that contributes to cause reduced incomes and low confidence, and that all has an impact on the housing market. And we can see here on the right hand side is where we're kind of predicting house prices to fall kind of in 3 consecutive years: 1.6% in 2023, 7.7% in 2024, and then a further 2.5% in 2025. And all that kind of falling house prices, falling demand, a smaller risk appetite from lenders, that will feed through into lower supply as well. So the $1 million question: where will we end up? The longer the war goes on, the more likely we'll drift towards the downside scenario, so towards the yellow line. We'll probably end up somewhere between the two, but the longer it goes on, the more we'll drift towards that downside scenario. So finally, on the next slide, just to kind of sum up what myself, Fran, and Fionnuala have talked about today, and I appreciate we have covered a fair bit of ground. So in the macro view, inflation, global challenges, domestic political uncertainty means things in the short term will deteriorate before they get better. In the housing market, by contrast, and considering all the challenges, it's in relatively good health. The majority of existing homeowners are sheltered from the risk of a crash, but renters, particularly, but not exclusively those at lower income levels, and SMEs are exposed. And kind of on the economic forecasts, our central scenario is, it's a fairly gloomy forecast, with high inflation falling away quickly, a significant hit to real incomes, and a cooling in the housing market with a slight correction in house prices. And there are many risks on the horizon. Predominantly towards the main risk is of a severe and prolonged war in Ukraine. So thank you, thank you for listening. I think I'm going to now hand over to Victoria to facilitate some questions. Thank you.
Thank you, Imran. That's fantastic. And you're receiving a round of applause, which is very well deserved. Thank you to the team. Wonderful. And thank you so much to everybody who've popped your thoughts, ideas and questions in the chat. I know a lot of them have been responded to, but I think quite a few probably do merit more of a conversation. So if we could ask Fionnuala, Francesco, Imran to come back on the screen and create a wonderful panel for us. Thank you. So yeah, you've given us a real clarity and explained so many big issues, big world issues that we've all been talking about, UK news-based issues that we see on a daily basis, and those sector hot topics. That's fantastic. If we can start off with a question for Fran. I know this is a topic that we're all very aware of, and it's great to get that clarity. And the question came in the chat. Surely Brexit has also had a major effect on contributing to the 5% gap, not just COVID. Over to you, Fran.
Thanks, Victoria. And yes, and we've touched on this in the chat as well, because I wanted to clarify that straight away. But yes, Brexit will have an impact in the long term. However, in the last 2 or 3 years, the impact of the pandemic was so much larger than what the Brexit disruption could have caused, that it's just not in the same ballpark in terms of an impact, and it's to an extent in the same field as inflation. So Brexit surely will causes some friction in terms of trade, but the cause of inflation is not Brexit, is global factors. So it's important to keep Brexit in our mind when we think about the medium and longer term, but in terms of the shorter term changes that have happened, Brexit hasn't played as much a part as we would think.
Really clear. The next question is on cost of living. And Fionnuala, I wonder if you could answer this for us. How do we manage the tensions between cost of living versus pay rise increase?
Well, that's a really, really good question. And it's something that the Bank of England are really, really worried about. And if you remember that the governor made a rather unfortunate comment, really sort of saying, oh, we've all just got to be restrained and hold back and, just deal with it. But obviously that's very, very difficult. And this is where government spending also comes into play. So the government doesn't want to increase public sector pay significantly for 2 reasons. One, it adds to its own public debt, but also because it sends a signal about wage increases. So that's very difficult. But it does recognise that the cost of living is causing a great deal of hardship, and that's why there's this sort of sprinkling of welfare changes. So a grant here, a discount there, and so on. So that's how they're dealing with it at the moment. But it's not really sustainable. Now, there's going to be increasing pressure. We know there's going to be increasing pressure on government with this, and increasing pressure on the Bank of England as well. And that's that falls into their play about how quickly they increase interest rates and how much they might squash any recovery, and they don't want to achieve that. So it's a brilliant question, and I think the answer is that tension's going to be around for a little while, and we have to deal with some of it, but there will be some sprinklings of help from different quarters.
Fantastic, thank you. So another hot topic, particularly for the housing sector, and Francesca's right, we had a session on this, nutrient neutrality, last week, and the recording of that will be available on our YouTube playlist later in the year. But a number of questions did come up citing nutrient neutrality, but also water neutrality. And the question here says, with the issues of nutrient neutrality slowing new development permission being granted, do you sorry, I'll start again. With the issues of nutrient neutrality slowing new development permission being granted, do you foresee house prices increasing further?
I'll take this quickly because I covered nutrient neutrality. So this is a tricky question because it's not just the number of permission, and it's not just supply that will end up affecting affecting house prices, but it's also the whether there are distressed sales or not, and there are other issues like the ability of finance a purchase or not, and in the chat we've just had a comment to that extent. So it's much more complex than just saying because there are struggles with planning in a certain area, then prices will shoot up. Because developers and transactions in the area will still be able to happen, and this non-new build market usually accounts for the largest majority of the market. So even if we can't build new houses, this transaction of the existing houses can still take place. So it's a bit more complex than to say definitely there will be a shot up in prices, and prices will definitely increase in those areas. It's much more difficult than that, unfortunately. However, we can see that actually we see prices, and Imran has touched on it, moderating a bit, and this will change by region and depends on where demand goes in the future, and if we want to see more people moving back to cities or to places where neutral neutrality is an issue. But I'm afraid there isn't a single answer for all the places that are affected by neutral neutrality. What we can say is that the issue right now is particularly challenging for SMEs that are not necessarily able to manage the risk, the additional planning risk that this causes.
Thank you. I have a question now for Imran. And this asks, why do you think inflation will fall away in 23-24, and what will cause this? And whoever's put this in the chat said, I understand lending rates will increase, but what other influences will affect this?
Yeah, a really, really good question. I suppose I think there were probably two reasons. So one is an arithmetic reason. It's kind of the way inflation is kind of calculated. So in 2023-24, it's the inflation is going to be compared to the rates we're seeing this year, which are very, very high. So that's one of the reasons why it's purely kind of a calculation point. So that's one point. But the other point I would highlight is the kind of the nature of inflation that we're seeing. It's predominantly driven by a supply side shock, with kind of energy and food prices increasing as a result, predominantly but not exclusively, of the conflict in Ukraine. And in the central scenario, that assumes that's going to ease over time, and that predominantly affects goods and not services. And we know the nature of the UK economy is a large portion of consumption is services. So they're kind of two of the reasons why it's forecasted to fall away relatively quickly. As all good forecasters, I will add a caveat and say it's a forecast, so could be wrong, and that's why we have the scenarios where in our downside scenario, it doesn't fall away as quickly and it prolongs over a period of time. So that's that question is a great example of why we have a scenario approach to account for different possible outcomes.
Thank you. I really enjoy those caveats, and it always reminds me of the winter of 1989, if anyone can remember that, when we were told there wasn't a hurricane coming. So this question for you, Imran. Actually, no, this question, sorry, Francesco, I think you've put your hand up for this one. Has Homes England looked at the actual impact of interest rates? The Dutch Central Bank has published research that showed that house prices were mainly driven by the ability to finance a purchase rather than a demand and supply issue.
This is a brilliant question. The first caveat that I should put to this is that I'm sure the Dutch Central Bank has a larger research team than Homes England has. We are 10 people strong, and we're very proud of the work we do, but I don't think we have the same firepower as a central bank. But we have looked at it, and yes, there is similar research on house prices from the Bank of England. If people are interested to look into it, there is, the housing market is a tangled web. So even if and we've seen in that chart earlier on affordability of mortgages that house prices and the affordability of interest rates plays one part and then pushes prices on the other side, but it's not the same. It's not the only aspect. And in the same way that having cheap or very expensive finance wouldn't by itself solve the housing crisis. Having a limited supply may not necessarily solve it either, because of the way market actors behave, and because those models are not particularly good at predicting how, if making things cheaper or more expensive, people's behavior may change. Now, you probably are happy with one property, but if that stuff gets cheaper, are you going to build a portfolio of properties or not? So it's a bit more complicated than just looking at the affordability of rates. But yes, clearly, cheap finance means that things get slightly more expensive and people are more likely to buy it. And so we're seeing that reverse, and that may have an impact, not necessarily on the absolute price, house prices. So we don't necessarily have to see a fall, but definitely on the rate at which they will grow.
Fantastic. So I think we've covered in the chat or through this Q&A pretty much all the questions. So thank you so much to the panel. That was absolutely fantastic and fascinating work that you're doing. If anybody has a question that hasn't been answered, right at the end of the session, there'll be an email address and you can email us and we'll make sure we get back to the team and see if we can get an answer to you. If we could go back to the slides. So thank you to Francesco, Fanula and Imran. And they also supplied us with some take-home messages. So this is something that we're going to share with the slide deck. And there's some top tips from the team. Also some key organisations, websites that they think you should have a look at if you want to do some further learning. And then some further guidance documents or research documents to have a look at. If you do have a question that hasn't been answered, here's our email address. Let us know. And it just leaves me to say a big thank you to our speakers and to everybody for attending today. Thank you so much. See you soon.